Yeah, is that where thinking about the business model is really key? And how big is the market?
Yeah, how big's the market? Is the top line really growing as well? Is it a growth market? Is it a static one? What's management doing? If they're making acquisitions, they're making out their own cash flow. How's that going to propel things? Yeah, so you get a lot of aspects to consider.
When you started investing in CVS, did you perceive them to be able to grow to the size that
Oh
they
yeah,
have?
they were a very aggressive,
So,
ambitious
so the
management team.
the
Very
signs were there
aggressive.
early on, were they?
Yeah, they
Right.
were, and also fueled by cheap debt at one point, which got more expensive.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Good to be here. The sun is shining, which is good news for once.
It is good news, but unfortunately, the football didn't come up, did it?
Yeah, I
It,
know.
it
They didn't
wasn't to be.
deliver. No, they didn't deliver. And they didn't deliver, sadly, in the entertaining way I was hoping for. Anyway.
No, no. Spain did.
Oh, they did. They were fabulous and deserved winners. Yeah.
Yeah. On to 2026.
Yes, I know. And we've still got the players. Come on,
It'll be
guys.
60 years then as well, Chris.
Oh,
60
so
years. You,
legitimate. We can
yeah.
rehash the song again for the
Exactly. That's what
Euros.
I'm thinking.
Yeah.
Yeah, brilliant. So we'll move on then to what the topic of this podcast is going to be about, which is, of course, stocks and investing. We're going to jump into Burberry replaces its chief executive and warns on profits, and then move on to the more positive side of retail, Frasers and good results. And then in the small cap world, we've got a bonkers bargain to discuss, Alumasc, Artisanal Spirits, ME Group, odd name, but great results. And then Renold, Spectra Systems, and I'm going to finish with Sasander. We've got a few talking points.
Yeah, we'll skip through a load, but there's a load of retail stuff. Everybody knows retail. Everybody likes retail. It's something that everybody can relate to, see, feel, touch, have their own big opinion on it. And I think there's some really interesting retail stories in there that are worth following.
Before we dive into all that, we're going to discuss the pension bill, which made the King's speech.
Yeah, I think this is fascinating. So the issue is to tackle all these so-called lost pots, these lost pension pots, and trying to automatically bring them together. And I just think this is a huge issue. A lot of people now will finish their working lives having countless different pension pots, even those that have just started with the advent of auto-enrollment, where you're having this little bit of money deducted from your salary. Even people that haven't been working very long are going to start accumulating pension pots, and they forget about them. They might be in a job for 6 months, 12 months, and they'll have accumulated a little pot, leave it, move to the next job. And after a while, you've got half a dozen of these things. And this is hopefully going to tackle it. This is still early days, but the idea is to consolidate all these pots into one low-cost managed pension fund, hopefully with emphasis on the well-managed, that will enhance pensioners' returns. The talk is that it will boost the average person's pension pot by 9%. That's a lot over the course of their career. That could be a heck of a lot. So yeah, good news. And watch this space.
It's good to see the government are trying to solve this problem, but I was thinking it from the actual individual perspective. What sort of culture or what sort of mindset do the people have where they've worked somewhere, they've acquired, let's say 2,000, 5,000, 10,000, even potentially £20,000 pension pot, and they've just moved on, and that money has just gone off into the ether. And they've got no way of tracking or tracing it, or not even the thought to think, hang on a minute, every month I've been paying X amount to my pension. I want to make sure that goes with me to my next job.
Yeah, well, that's exactly the problem. As you say, people are having this deducted from their salaries. They're not knowing where it's going. Probably they were probably told, but then they forgot about it. They're disengaged with it. They lack the interest in it. It's just crazy. And these can be quite, as you say, quite large sums of money. And something needs to be done. And you can imagine the smaller pots, the cost of managing a smaller pension pot is a lot more relatively in percentage than if it's a lot's accumulated. So there could be some really big savings here, which is essential.
Yeah, agreed. Where does the education come from? Does it come from the schools? So when people enter the workforce, they're aware of these types of things with pensions and saving and investments? Or does it come from the company when the person joins up and starts working for the company? Do they provide some sort of educational program about the
I think they need
pensions
to
and
have, yeah,
savings?
I think the companies now need to have an increasing responsibility for this because they're instrumental in deducting it. They're reporting it to whichever pension provider. But obviously that's all subcontracted out. But there needs to be more engagement, and clearly there hasn't been, because a lot of people are just clueless about it, which
Agreed.
is terrible.
Agreed. Shall we move on then to our first retail company of the day, which is Burberry, who's just replaced their chief executive?
Yeah, they announced another profit warning, and CEO's gone. They've suspended their dividend. The shares are slumped as well. And I just think Burberry's in a tricky position. It's neither one thing nor t'other. It's one of these sort of aspirational brands that are now really out of favor if consumers are struggling a little bit, notably those in China. It was booming in China. The first thing they're dropping is a kind of aspirational brand like Burberry. And it's one of those, I think we've mentioned this before, it's not quite luxury enough, not quite exclusive enough. We've heard that luxury goods are being discounted at rates as high as 50% in China. Burberry's in this melee, and it's not alone. The higher tier, the higher level ones like Louis Vuitton, Hermes, Chanel are not suffering. They haven't discounted. They're controlling more of their distribution, and they've avoided the discounts. They keep their price points at a premium. But yeah, I think it's been a big problem for Burberry, and they're not alone. Other companies in this space at their sort of level are also experiencing problems. Now, increasingly, I can't see Burberry as viable as a standalone brand. It seems to need to fit into another sort of conglomerate of brands, a house of brands, a bit like LVMH has. I just think and maybe given the decline in price, acquirers will be taking a closer look at it now.
Yeah. What would you need to see to show recovery?
Don't know. I'm not that great at luxury brands. One can have more evidence at the really top end Hermes to see how they've protected their brand, how they've nurtured it, how they've restricted supply, how they've kept it exclusive. And they've got hundreds and hundreds of years of heritage, as a Burberry. And Burberry lost their way a few years ago, didn't they? When everybody was sporting their tartan. And yeah, I've always struggled with it, to be frank.
Yeah.
We've never held the shares in our firm with Fundamental either. We've never held a position in Burberry.
Yeah, okay. Talking about high-end brands and how they've protected their supply chains and their manufacturing. What do you think about LVMH, who is one of the ultimate stocks
Yeah, it is.
constituents, isn't it?
Yeah, and we hold the shares as well in our fundamental and some of our general portfolios. It's a great business. It's got this houses of numerous brands, extending even to top-end hotels. But yeah, it doesn't sound very good when they're now being investigated for outsourcing manufacturing to Chinese-owned manufacturers who in turn are alleged to have exploited workers. And it was first reported, I think, Bloomberg this, and subsequently, and Italy's antitrust is now probing Armani and Dior. This is not Louis Vuitton itself, it's their Dior brand, which is owned by LVMH. It's just not good at all. When you're telling a top-end good, huge margins, you've got to be able to demonstrate that they've been made correctly and everybody's been paid correctly.
At least they managed to still say that they were made in Italy.
It's sort of, yeah, if in an unsatisfactory way.
No, I shouldn't say it like that. I don't mean that. But yeah, what they were doing it is only allegations at the moment.
It is, yeah.
It seems highly unethical, isn't it?
Doesn't sound good. And where there's smoke kind of thing, something's been going on clearly.
Yeah. Is there anything that for you, as this unfolds, would, as you've mentioned, fundamental own them? Is there anything for you that would make you think, oh, this might not look good?
Well, yeah, if they're found, we'd like to see what the remedies are and what's gone on. If we're uncomfortable, we get out of a stock like this. For example, we've never held as a firm shares in ASOS. Not ASOS, sorry, Boohoo. We were always uncomfortable with their positioning. We don't like ethically. We're not comfortable with the business, however cheap the shares may appear. And we'll go on to a firm that clearly thinks they're good value, but some lines we're not prepared to cross.
Yeah. And I think it might be fair to say that how far up the chain of command were they aware of it, of what was going on? Were the board of directors aware of this as well? That in a company of that size, it's probable that they weren't even aware of how these were being produced.
I know, but there's still no excuse, is it?
Agreed.
You need to have control over your entire manufacturing and distribution process. And when you are selling something at that kind of price point, and your consumer needs to be comfortable as well. They're not paying top whack for things to discover that something else that's been going on in their manufacturing process.
Yeah, agreed. Keep an eye on it and watch it unfold.
Yeah.
Should we move closer to the UK then, with some positive news from Frasers, who owns Sports Direct?
Yeah, Fraser's the sort of holding group name now for Sports Direct. Great results it came out with in a retail sector that's been struggling. Revenue still grew a bit. Underlying operating profit rose about 13% to 544 million, up guidance as well. So it seems to be in good shape, generating loads of cash, which is reinvesting in the business. It's gone through this elevation strategy. It's improved the look of its stores, which is noticeable. You go into a Sports Direct now, it's a far more pleasant shopping experience than it used to be. But yeah, Sports Direct's the key business. It represents more than half of Group's total sales, 2.86 billion sales, 350 million of operating profit from Sports Direct. And they focused in that area. And this is a business that really knows what it's doing in the retail world. It's a 73% controlled by Mike Ashley, who started this business in 1982. And it's now run by his son-in-law, but Mike still owns 73%. And it's got a reputation for making some weird and wonderful bets in the retail sector. Been called the savior of the high street. It's bought brands like Evans, Jack Wills. It bought House of Fraser, subsequently shutting a load of those larger stores. But it's also taken some interest. It owns 40% of Mulberry. It's taken a stake, 24% in AO World, the electrical retailer. It's got 23% now in a Boohoo Group, 20% of ASOS, and it's even taken 6% interest in Currys. All these investments were made last year. So clearly, Mike, his son-in-law, and the team at Frasers reckon there's value in the UK high street. And some of these shares, these investment bets, have turned out rather well up to now, and they're sizable. The value of these was nigh on £500 million at the reporting date. So this is a sizable commitment. So if you want exposure to retail, UK retail, look no further than Frasers. You get everything, a little bit of everything.
It's almost like the ETF of the UK retail, isn't it?
Yeah, and very canny operators in terms of distribution.
Yeah, excellent. So should we move on to the small cap world now anyway?
Yes, small caps. Good place to be, I think. We've seen a bit of a rotation this week out of the S&P 500 index has been underperforming the Russell 2000 small cap index over the last week, 10%. So are we seeing a rotation out of the mega caps? Are we seeing people thinking, hold it, there's better value in small cap world? If it starts in the US, hopefully we're going to see it more in the UK as well.
Well, you did a really good webinar this week. If anyone's interested in watching it, it was a really good webinar. You explaining this, the rotation out and about interest rates and things like that.
Yeah, we did a webinar. We, as in Fundamental Asset Management, our associated investment management firm, focusing on the appeal, the valuation of appeal for small caps, how they've never been cheaper, how, as you suggest, reduction in interest rates could be the trigger. We haven't seen that yet. We saw it in Europe. We haven't. It looks like we're going to see it in the States. Maybe the Bank of England may hold back a bit, but that could be the real trigger. And typically, things move sooner rather than before the cut itself. People are predicting it, and you'll see a benefit. But yeah, good place to be, I think, small cap. Having suffered for years, the last 2-3 years of underperformance, small caps could be the place to be, hopefully.
Can anybody watch that webinar?
You can go on our website. Strictly speaking, it's for professional investors, but you still have to you can register with your email address, and then you can access the webinar. It's about 45 minutes. We also answer a load of questions that watchers, viewers have asked us. Some of them are very pertinent. It's largely focused on AIM as well. AIM is the heart of UK small caps. So yeah, simply go on the Fundamental Asset website, look under the advisor section, and educational webinars. It's under there.
Yeah, I'll go one step further. I'll put that link to it in the show notes below. So all you've got to do is, if you want to watch that webinar, just scroll down, click the link, and you said mention details. What details? Email address?
Is that a name?
Just an email address. Yes. No.
Yeah.
Yeah. All right then. So there you go. It was a really good webinar, by the way. So I encourage everyone to scroll down and check that out. That was just this week. And yeah, so we move on to the small caps now. Got a bonkers bargain, Alumasc, showing good signs again, Chris.
Yeah, brilliant. This little business, it's part of our Bonkers Bargain series. We Fundamental hold it in our high income model as well, put high income AIM model, that's a higher yielding AIM shares. It's a sustainable building products group, and it put out a really good update. Revenue's growing in a horrible sector. Construction materials been horrible, but Alumasc is still growing. It's got a lovely little house building products business within its group called Timlock. But I would urge you to read our updated Bonkers Bargain note on it. But lovely little business that's trading at a very modest valuation, and you get a nice dividend off it. So you're worth having a look at.
Yep, hence the name Bonkers Bargain. And here's one for you whiskey lovers out there. Artisanal Spirits, which you've looked at, Chris, and if the value of this business may not actually yet be realised.
No, it's a very unusual listing. It's on AIM, and it owns the Scotch Malt Whisky Society, another business called Single Cask Nation that it bought, it was a US one, then a whiskey brand called J.G. Thompson. It's on the cusp of turning a profit. It hasn't yet. The shares haven't been a great performer since it's listed, but it was worth alluding to it. It's invested a lot in whiskey. It's got a huge stock of whiskey, and it's had it valued its stock of whiskey, where it's been putting a lot of money into it, and its estimated value of its stock of whiskey in total is about 100 million.
Right.
And and it's in the books substantially less than that, circa 75 million, 76 million less than that. So you can see could be a big uplift in the value of this business based on its stock value. That's only the tip of the iceberg. The core of this is that the estimated future retail value in the bottles is almost 500 million.
Oh,
So once you
wow.
get that's the future value, they get it out the door. And they've got enough stocks now for the foreseeable future, such as being an investment. And broadly, this company's worth over 30 million, which stock market value is 30 million quid. And its net asset value, based on its stock of whiskey, is obviously substantially higher than that. Potentially another bonkers bargain, but an
Yeah.
unusual one because we're not seeing the cash flows come through yet. This is purely on a balance sheet valuation basis.
Yeah, I guess it's they have to sell that whiskey, don't they, for that cash flow to
Absolutely.
come through, and
Yeah.
that's another piece of the jigsaw, isn't it?
Sell that whiskey profitably, yeah, which is key. So not a done deal, but for those that know more about whiskey than I do, it might be worth them having a look at it.
And as we move seamlessly from whiskey onto chains, a company called Renold, a very old company, a company that you've been looking at in great detail, and you still are on the fence. Why is that, Chris?
I've been beating this one around a lot. It's a very elderly chain business, a manufacturer of industrial chains. It does make high-end bicycle chains as well, and chains are everywhere. They're used in all sorts of industrial automation, conveyors. You see them everywhere. Hans Renold launched this business back in 1879. It's been around a long time. It's just put out great results, and it's got a lot to appeal. The valuation's very cheap. It's seemingly it's trading at a single-digit multiple. And there's a lot of interest in it. It moved from the main market to AIM. However, there are some issues that people need to be aware of. It's got a huge pension deficit. Eventually, its pension fund is as big as the company itself, 140 odd million, I think. And it's got to keep funding it. So it's using its cash flow to help keep funding that. I think management probably have been overpaid as well. Huge number of share options as well that you've got to really understand. So earnings are a bit more dilutive. I tell you the big issue for us. It grew its profits, but its revenue is not moving forward. Actually, despite making acquisitions, its top line revenue is not growing. That's always a bit of a red flag for us. And if you're not growing your top line and your profits are effectively coming through cost efficiencies and savings, those cost efficiencies and savings can only take you so far. There is a limit to what you can achieve, in my humble opinion. And that top line has got to be moving forward. Clearly, with an elderly chain business, it's a fairly low growth market, GDP plus, and that would be the main issue with us. But is that already factored into the valuation? Who knows? But worth those interested in elderly industrial groups that are potential recovery stories. The shares have already performed quite well this year over the last 12 months. Conceivably, there could be more to go for, and aren't too worried about pension deficits, dilution to earnings, share options, overpaid management, who have done quite a good job lately, in fairness. Yeah, it's worth looking at. But again, I'm not so sure. That top line growth is key for us. You've got to be moving it because sooner or later you could see things struggling. I'm really on the fence on it, and I've looked at it a lot. I've looked at it again, and it's the sort of stock as well. How far is it going to go? Problem with for a small cap investor, if you're managing a bit more money, it's how can you get out eventually? What's the play here? This is the irony of it. A lot of the time, the only way out for a lot of these small cap managers is engineer some kind of takeover. I'm not that keen on more takeovers. I hate that thought, losing more and more companies. I want to see a business continue to grow. If anything, I'd love to see, dare I say, exponential growth coming through. You're not going to see this from an industrial train grid. You're going to be looking at when you need to jump off as well as when you've got to get on. So it's a tricky one for us. I really struggle to understand as an investor in a business like this one.
Yeah. Is the Renold family still involved?
No, I'm
Long gone.
aware of, long gone. Clearly, it's a long time ago. And it's been through countless acquisitions, mergers, demergers over its history. And yeah, we end up where we are now.
Have you looked closely at ME Group as well? I find it an odd business model,
I
really.
find it an odd name. It used to be called Photo Me. It owns all those photo booths
Yeah.
you see around. And it's also been growing strongly in unattended laundry services. So it specializes in vending equipment that it provides to large sites, supermarkets. You see them in the car parks and things. So it's got Photo Me, Wash Me, the washing machines, Print Me, digital printing kiosks, and Feed Me, vending equipment for food service. It's all this brand. But yeah, it's bizarre that it's growing strongly in laundry services and laundrettes. And the results are great. They own their machines and they operate them, and then they service them all, and they make decent returns on equity. Cash flow's been great, but they're reinvesting all their cash into more and more machines. They plan to install 2,000 to 2,500 next generation photo booths. You can take your picture and digitally send it, for example, to the UK Passport Office, which is quite nifty. But it's the washing bit that it's revolution washing machines. I didn't think there would be such huge demand for them. And it's not just in the UK, this is around Europe as well. You
Mm.
tell me, is this a growth area?
I've seen them dotted around in like at petrol stations, and I've struggled to wonder why people would use them. I've never actually seen anyone using them, to be honest.
No, it's bizarre. And you've got to wait for a wash cycle. I don't know how fast they are, but
Mm.
if they're in the shop, you've got to spend an hour and a half in the shop to do the wash and the dry, because they got dryers with them. Clearly, I'm not the target market, and I would be interested to hear from somebody who is the target market. For me, it's a laugh at me. I just don't get it. But they're doing very well. The numbers speak for themselves. But operating margins 20%, 30% return on capital. So it's just this is a pretty good business. The numbers say it's a great business. Common sense suggests, wow, how they're doing that in what should be a fairly static market. Free cash flow before they were plowing into all these new machines was fantastic as well. And unlike Renold, who we mentioned before, this is a business that's growing its revenue despite the somewhat, should we say, questionable markets they're addressing in terms of growth, at least. They grew revenue 9.5% for the 6 months. So, yeah, great.
Yeah, absolutely. And moving on to another company as well, which you would think, again, this is a non-growth area, but they've just won a great contract, and that's Spectra Systems.
Yeah, it's amazing. It's a leader in machine-readable high-speed banknote authentication, and they've just got another whacking great contract from an existing central bank customer who's actually, in addition to this huge contract, who's paid them over the years about £14 million, $14 million dollars to help develop this new technology. Sensor manufacturing. It's just very interesting in an area, as you would say, banknotes that
I
are
think it'd be a
losing
shrinking
appeal.
market, yeah.
Yeah, you would. They haven't mentioned who the central bank customer is. I'm not sure who it is, but it's clearly an area where banknotes are still in wide use and not in declining use as they are in other markets. But yeah, this is game changing for this business. Clearly, what investors need to grapple is, are these one-off contracts, which appears to be the case? What's the ongoing service revenue element of this going to be when these things, the machines are installed? And what's the longer term potential of this? Is it still overall a declining market? Are they fighting against the tide with this thing? Great contract win. Again, it's part of we hold the shares in our fundamental AIM high income portfolio. It's been a decent yield, but less so now because the shares have been doing quite well. But interesting business that you wouldn't think necessarily would have much growth appeal, but which has been delivering fabulous growth.
Yeah, so I guess do you primarily hold it for the income then, and
We do,
the
yeah.
growth has been an additional
Yeah, I mean,
byproduct?
the trigger was the dividend appeal, and liquidity's not that great either, so we can't hold it in our main book, so we hold it in our smaller high income AIM book, and yeah, it's done well.
Yeah, perfect. And the companies that we've shared there are companies that they know their markets. They have clear business models, that they seem to know what they're doing. The next company we're going to discuss is perhaps the polar opposite of that, and that's Asander. They started off online, and now they seem to be opening physical stores as they've pivoted and readjusting their business model. I mean, it's really just to kind of demonstrate the contrast between companies who have a clearly defined model, they know who their target market is, they know business model is, and a company that, from the outside, seems to be struggling with that.
Yeah, as you say, they started off life as an online concept, never made a bean really, and now they've decided to open physical stores out of town. I just don't get it. It's currently valued at just £25 million, as I say, barely profitable, little evident brand value or brand strength. In our book, everybody waxes lyrical about brands. So a brand to us has got to be profitable. Otherwise, what value as it if it can't make, if the brand's got no profits attached to it, or at least has at some point in its lifespan. It's still experimenting with its business model. There's a clear sort of lack of focus. It's gone down one track, didn't work, trying this new one, halted the growing to the top line. We struggle to understand the positioning, if it has a unique selling point. I hope it works out, but it hasn't been an easy ride up to now. And again, in that retail world, anybody could probably assess this probably a lot better than us. Is its positioning? Does it appeal to you as a consumer, what it's selling?
I'd never heard of it before.
No, I've never seen it. It's ladies' fashion.
Well, that's probably why I've never seen it then. I'd have to ask my wife. She's heard of
Yeah.
it. Oh, it's interesting that you mentioned they're still trying to find the business model that works for them and
Shouldn't you arrive at the stock market having certainty on your
a
business model?
proven
It's
business model.
arrived in the stock market as a startup. It hadn't even got going. It was just funded as a startup. So yeah, I do worry about this one. As I say, a dose of common sense suggests it's struggling to work things out.
What I've just took from this podcast episode is that it's not always about, oh, this company's going great guns. You've got to get into this company, that company. It's actually being able to identify the companies to take a second look at, really think about it.
It's difficult. That's the nature of investing, as you say. It's very, very hard. And say Renold may start delivering that top line growth. It may continue to squeeze efficiencies out, which will deliver greater profitability. It may sort out its pension fund. Its management remuneration may be better. It may cover all those bases. Sosandar may work things out. You have to take a decision. And I say, going back, in the world of retail, it's much easier for the consumer to really have a good understanding. You just have to buy things from retailers, visit their stores, visit their websites, experience their offering, experience their customer service. It's far easier. In the world of industrial chains, it's a
bit
lot
more
harder
difficult.
unless you have real expertise, unless you're in the conveyor business and know how good their products are and how much more prepared you are to pay up for their products rather than something made in an emerging market segment, which is maybe cheaper but less reliable. Doom is the issue with a Renold.
There's pros and cons, isn't there? It really demonstrates the challenge sometimes with some of these companies and how to analyze them.
It's no free ride. And a lot of these are going to be driven by momentum as well. All you need is somebody who's got a big following, media, online following that starts pumping these tiddlers, and they can get the share price moving. It can be a bit of a false market as well. You need to be aware of. So yeah, beware the sort of stocks driven by bulletin boards. We had it in the States with these meme stocks.
Yeah.
You can see if you have US is a whole different level. These were bigger businesses, but you can see if you suddenly get an online following, who cares about valuation, common sense? That absolutely goes out the window, and the share price shoots.
And does that go on in the UK as well? I knew it was a big thing in the US.
No, I haven't seen it. The meme stock craze. You haven't got the population of punters.
There's not the same interest here in the UK.
No. You haven't, and you haven't got the same sort of high-profile companies that it would appeal to, really. What you do have is often the bulletin boards and the chat rooms pumping up tiddlers, 50, 100 million market capitalization with limited free float. So it doesn't take much with a bit of excitement on the bulletin boards to start moving the share prices of them.
We see a lot of that in crypto, haven't we, with that probably Gen Z generation that.
Yeah, there you've got a lot more fervent sort of passionate trading going on. It's different. That's a bit, but that's a global thing as well, isn't it? It's not just UK.
Yes, it is.
It's across the world.
But I guess equally, if you've done your research on these companies, whether it be the micro caps, some that we've mentioned here, if you've done your research and you believe in what the management are saying, you trust them, the company's doing well, even if there is chatter on the bulletin board and the share rises or rockets up, still probably the right thing to do is to hold on to it anyway long term, because you've done your work, you've done your research. Is that a fair comment?
Yeah, no, it is. The difficulty with all these, as I mentioned in the talk, is how do you get out of them? It's one thing getting in, but you get to the point, and if you're managing institutionally with any size, so look, to argument, say you're managing £100 million, which is diddly squat in investment terms, and you've got a 4% position of your book in one of these stocks, you've got £4 million. These things are only trading £200,000 a day, shares, maybe not even that. You can't get out of them. The only way you are going to get out is as I've said, engineer a takeover of it. I'm not a big fan of that logic. I like to buy business for the long term. I like to buy a small company that conceivably get an awful lot bigger, 10 times bigger. That's the real thrill of small cap investing, not to be taken over for twice its value. Yeah, it's great news, whoopee-doo short term, but it'd be nice if they went on to even better things.
Yeah, is that where thinking about the business model is really key? How big is the market?
Yeah, how big's the market? Is the top line really growing as well? Is it a growth market? Is it a static one? What's management doing? If they're making acquisitions, are they making out their own cash flow? How's that going to propel things? Yeah, so you get a lot of aspects to consider.
When you started investing in CVS, did you perceive them to be able to grow to the size that they
Oh, yeah.
have?
They were a very aggressive, ambitious
So
management team.
the
Very
signs were there
aggressive.
early on, were they?
Yeah, they
Right.
were, and also fueled by cheap debt at one point, which got more expensive. But yeah, there was an ambitious management team in the infancy of the consolidation in the pet sector, which was growing as well. So greater pet ownership across the board. So you had a growing sector, growing value, and also you had a sector that needed consolidation and the benefits of consolidation. And ironically as well, it's a very lowly paid sector that. You've got to be super qualified to be a vet. But in relative terms, you can earn 20 times the amount in the city of that qualification. So they're actually quite relatively lowly paid veterinary surgeons for their educational qualifications.
I'm not sure if you're a pet owner, you think that when you get your vet's bill. So that money's going somewhere.
I agree. It looks horrendous, but all that draws to my attention is how much the NHS is really costing as well.
Yeah.
You don't see that. When you go in a hospital, go and see the doctor, you don't see any of that cost.
No, you're right. Yeah, that's
But
true.
you do. It's right in your face as a pet owner.
It really
Smack
is. Yeah.
bang.
Yeah. I've just recently experienced it.
Oh, I know. It's horrendous.
Yeah.
It's not great. And there needs to be more visibility of what you're going to pay. We'll see what happens from the CMA review. But yeah, it's obvious. The CVS is obvious where it was.
Yeah.
There was a growth.
Is there any companies like that at the moment or any areas, any sectors that you see that are ripe for that type of growth?
But you got the cyclicals. Alumasc mentioned, if the cycle turns, construction materials, they will absolutely be flying, especially in the UK. You got a business that's still growing its revenue, using its cash to buy other businesses, and part of its business, all of it exposed to the UK, is in the doldrums. So you can see there could be a big acceleration there. Craneware addresses the US healthcare sector. Big, it's massive, and a growing sort of issue that it's trying to deal with there with the value healthcare. So then that's growing as well.
Yeah, we mentioned Craneware, didn't we? Was it the week, not last week before, I think?
Yeah, it's a nice cracking business. They announced this week as well, a nice update. But again, growth play. Yeah, they had a partnership with Microsoft to start using in developing some AI functions into their huge data set. And this business has got access to all these American patient records, what they've been. So you can imagine if you start crunching it using AI, what it might reveal.
Yeah, headquartered in Scotland, if I remember.
That's it. Yeah, Scotland, and that's it. I remembered it. But no business at all in the UK, all US. There are a lot out there. There are a lot of good companies, but it's tougher in the UK. You go in the States and things, rather than growing 5%, 10%, they're growing 25%, 30%. You know, if you have a new retail play, a new retail play in the US, wow, if it takes off, boom, your turnover will be doubling every year.
Hopefully these new listing rules that the FCA has just greenlighted will hopefully improve some of the companies over here.
Yeah, I hope so. I think something needs to help.
I wonder how many Americans would lose track of their pensions in the same way that British savers do.
Interesting. It'll be interesting to know that.
And
they're
I
far more cognizant of investing,
yeah.
finance. They talk that game, don't they? I'm sure a
Yes.
lot of people are ignorant of it as well, but generally speaking, the culture out there, the equity ownership culture is far greater than it's become over here.
Agreed. Should we leave it there?
Yeah, that'll be good.
Yeah.
Interesting little mix of businesses again.
Yeah, I think so. There were some really good companies there to take a closer look at and ones to avoid.
Perhaps, or not.
Perhaps.
Who
or
knows?
not.
Who knows?
Yeah, that's up for the audience to make that decision, isn't it? Thanks, Chris.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.